Lucky number 7 for the Dow. It's the 7th consecutive day we've seen gains, leading the Dow to reach another closing high, setting a record every day since Tuesday. Here to weigh in, Frank Fantozzi, President and CEO of Planned Financial Services, Alan Haft, financial advisor and author of You Can Never Be Too Rich or Too Thin or Too Blonde. That's not the name of it, is it?
I like that.
Jordan Goodman, personal finance expert and author of Master Your Debt. Welcome all. I'm going to start with this market, guys. Jordan, to you first. Can it keep going up from here?
Absolutely.
And what do you think we're in for as individual investors?
Well, there's just a tremendous amount of money coming into the market right now. People had been going into bonds before, but now they're going into stocks heavily. As usual, they get in late in the party. I mean, here we are almost exactly 4 years from the March 9th low.
I know. This could be the start of something bad. We just don't know,
The
right?
Dow's up about 140% in the last 4 years.
And you know,
and now people get in, right?
Listen, Alan, I have to bring this up with you because this drives me crazy. You know, I still get so many emails from people who are saying, I don't trust the stock market. I don't want to get into the stock market. Why are you talking about the stock market? Do you think people will ever get over what happened to them in 2008, 2009, all those years where the market was adrift?
No, I don't. I mean, we're still feeling some of the hangovers. I know a lot of people are still sitting on the sideline even after this big run-up. The fact of the matter is that most people shouldn't be trying to time the market. Whether the market got killed in 08 or it's up a lot right now, you really should have some sort of a semblance of a plan so that you're not trying to second guess. Should I get in now? Should I get out? Should I get out? Should I get in?
It's always better to plan ahead. Frank, to you, as you look at this, what are your clients saying to you? Are they saying, wow, I wish I got in, or are they already in? What's their view of the market right now?
Well, right now they're asking, what should I be worried about?
Right.
And comparatively speaking, the equity markets in general are a safer place to be than in fixed income, especially as you relate to the traditional safe haven of treasuries. With a little more interest rate movement, I mean, even on a 10-year treasury bond, a 1% move could spell about a 10% decrease in the value of your portfolio.
Well, and Jordan, I don't think people get that.
They don't. A lot of people have been pouring money into long-term bond funds, particularly. Last year, $400 billion went into long-term bond funds, and they don't realize at all the risk. They look at the returns. We've had a 30-year bull market in bonds. So what could go wrong, right? A lot could go wrong.
A lot could go. Well, explain, because I don't think people realize what they could be in for.
So if you got in now, basically long-term treasury is about 2%, a little bit more than 2%. And say rates went up to 3%, which doesn't sound like much. That would easily wipe out all your capital gains from all these past years and whatever small income you're getting. Back in 1994, you might remember there was a big bond surge. Rates went up a little bit. People lost on average 24% in their bond funds. So people don't realize the kind of risk they're taking being in these bond funds.
Wow, that's so scary.
I got something to say about that.
Sure, go ahead.
All right.
I can't tell who it is talking.
This is Alan talking.
Okay, Alan.
You know, the unemployment's right now at about 7.7%, but when you factor in the people that stop looking for work, it's actually a lot higher. Fed has made it very, very clear that they're not going to stop buying bonds until the unemployment rate's at about 6.5. You factor that in along with the sequester, the loss of jobs that are going to come up. I still think it's a long ways until interest rates go up.
All right, Frank, do you agree?
Yes, well, the Fed has pledged to hold interest rates low through 2014, so for the foreseeable future, I think that's going to stay the same.
The Fed's controlling short-term rates, but they don't control long-term rates. Okay, and that's what these bonds we're talking about have a lot of money in. I mean, the long-term rates as of January 1st were about 1.3, something like that. That's already gone up to 2% in the last 3 months or so.
You believe this could turn around quickly?
Yes.
All right, Alan?
I've been hearing this for the last couple of years. Rates are going to go through the roof. Get out of bonds. Get out of long-term. I'm not saying to reduce down the risk in the portfolio.
All right, but we're sitting here talking about treasuries. What about munis, Jordan?
Same kind of thing. They've got a lot of risk in those. Now there's more default risk. Not exactly default, but at least delinquency risk. We've had some defaults. We had Harrisburg. We've had a place out in California. So there's more default risk at least the federal level. They're probably not going to default. We have this national debt ceiling, but they just keep raising the money and can print it. But municipalities have more trouble.
All right, I want to get one other topic in here quickly, and it's a story that I've been just so excited about, I guess I'd put it. John Paulson, remember John Paulson, the hedge fund manager that made so much money betting against us, our mortgages, right? He's got billions of dollars.
Right.
He is moving to Puerto Rico because Puerto Rico has this new rule for new residents. You don't have to pay capital gains taxes. You don't have to pay U.S. taxes. You don't have to pay any taxes in Puerto Rico on your gains. Frank, to you.
Well,
Are your clients saying, hey, Frank, get me out of this tax situation. I can't afford this 50% rate that I'm paying?
Well, it's very enticing to sit there and think that you can pick up and leave the United States, but I think the big issue is, are you ready to revoke your citizenship and all the benefits that go with that? I think when you take a look at the super rich, they have that ability. So if they're planning to sit there and run off into the sunset, that's a viable option. But for your people that are making $400,000 to $1 million, which are considered still very wealthy individuals, that type of planning is not going to probably be realistic for them.
If you're in Puerto Rico, you keep your citizenship, by the way. That's not a problem. It's the taxes that you avoid. He has no.
So it's the best of all worlds.
It is the best of all. You get the sunshine.
You keep your citizenship, and you don't pay the taxes.
Zero taxes on capital gains, 4% tax on business income. So all the money he's making, he made $15 billion when he bet against the subprime. And now he's saying.
I think he has like $9.5 billion right now.
Something like that. He's buying like a $5 million home. It's just outrageous. And he is the most hypocritical of all, because remember during the Occupy Wall Street situation, he was saying, you know, we rich people pay our taxes, you should support us, don't give us a hard time. And here he's running to Puerto Rico.
Alan, last word.
Jerry, I have an easy solution to this. Instead of moving to Puerto Rico, if somebody wants to save money in taxes, just move to Florida. It's still in the continental United States.
You're
closer to home. You save yourself the tax.
Yeah, I'm ready to go.
Right.
I just saw the pictures. It was mighty pretty, and it looks warm. All right.
On.
Frank, Alan, and Jordan, thanks for coming on tonight.
Thanks.
Great job,
Thanks,
guys.
Terry.
Interesting
Thanks for having me.
conversation.